All right, we are live. Hello, everybody. Welcome back to SoFi Weekly, episode number 9. I am your host, Amit. With me, we have Riley. With me, we have Tanner. We have Chris, and not the Bear Chris, the SoFi Chris. And we have Dividend Streams, also known as Steven, who just passed 1,000 followers I saw on Twitter the other day. So Steven's getting...
Did I really?
Yeah, you're like 1,034. Last time I took you, you're like 800. So that's great.
Look at that.
Awesome. It's phenomenal. We are here to talk about SoFi because it is SoFi Weekly. Thank you, 24 people, for being here already at 10 p.m. on December 2nd, 2022. 3 main topics today. Number 1, SoFi options coming out. Number 2, student loan updates. And number 3, we will be offering some counter perspectives towards a bear argument we got in the community last week before Thanksgiving. So let's get started. Options are out. Tanner, you want to start on this? What'd you feel now that we have options?
Yeah, so it seems to be a half launch for the most part. Although I'm hearing supposedly from the same people that said that the rumors that it was going to release on Monday and then it released on Wednesday, 2 days off. They're now saying that, level 1 options are now going to be released in January.
Wow.
Seems early, but who knows? If we do believe that the rumors are true and the same people are confident. It's not Bender 9000 or anyone like this, so it's not 100% guaranteed. But yeah, I personally don't have hands-on access with it, so I don't know exactly how it feels. But hopefully, people will start to cycle in that people that are using just generic calls and puts are actually wanting to use our platform versus Robinhood's or something like this. But right now, it doesn't seem like we have the full options platform out just yet.
Okay. Chris, your thoughts on us getting closer to a full options platform being released?
So I have only the same sources as Tanner here. I know. So personally, I write CSPs and CC, so covered calls and cash secured puts, like on yeah. There you go. It's like a dividend for a growth stock. Anyway, it's kind of how I think about it. And so I won't be moving my accounts over until they release those level 1 options. But I'm excited. I'm excited for it to be live. I'm excited for them to be working on it. People have been asking for it, including myself, for quite a long time. Every single SoFi thing that they've sent me that I've had to fill out, I've always mentioned that as one of the things that I'm waiting for. So,
right. And now, but the actual, I saw that you just took a screenshot of the app. How do you think it feels? The options in general. Do you think it's a good platform? I heard it might be a little bit different than the rest of the SoFi Invest platform, where it actually is, not laggy. And
so that screenshot wasn't mine. I sent it from somebody else. So I actually haven't had the opportunity to play with it yet, unfortunately.
Gotcha.
It looks good to me. I mean, it's got everything. All the Greeks are there, pretty easy. It looks like it's fairly easy to navigate. But again, I don't actually know.
Real quickly, I just want to say about like 30 seconds ago, the CFO of SoFi just followed me on Twitter. So that was really weird.
Ooh, Liz Young?
No,
Chris LaPointe.
Chris LaPointe just followed me.
Okay, so what does Liz Young do? She's the COO?
She's
What does she
the
do?
head of investors, or not investing.
Okay, gotcha. I thought she was the CFO. Okay. That's cool. So Riley's getting all the SoFi people to follow him. Steven, what were your thoughts on options coming out? And I guess, can you speak to a little bit of what this means for the stock long term in terms of revenue, or not the stock, but like the company and the revenue we can generate from options? Will it be substantial? Is it a good thing, or is it just something you gotta have to have so investors don't cry about it?
It's not bad. Let's leave it at that. It's not bad.
But is it really good?
What SoFi is trying to, like, in all their advertising, they're just making it. They're coming off and advertising the simplicity of the product, making it really simple. And for that part, I agree. It is simple, and it does have a good educational factor to it. But it's like bare bones. I think they're just putting their toes in the waters before they get like anything crazy.
Options is a revenue generator. I believe on TD it costs me 75 cents per contract to write, and then maybe a penny per share. I don't remember the exact breakdown, but it really depends on the demographic that's using SoFi as a brokerage service and how many of them want to either trade options or sell covered calls or cashback puts or any type of options contract. Look, it's definitely good. How good it is, we need a couple of quarters of data to see, and we're really not going to know until the full product is out because you don't have level one. And as Chris said, if we're not able to write covered calls, that's part of the market. So we need a couple of quarters, but it is good. We'll see how good.
So if I guess to talk about how much revenue we could be generating here, here, let me share something real quick.
How much does Robinhood generate? Does anybody
That's
know?
exactly what I'm gonna pull up.
When you press present and then share screen, it'll pop on mine, and then I'll open it.
Okay, and I don't need to share system audio.
Robinhood does make an ARPU, average revenue per user, of about $63 per user, and that's primarily based on those options. So
All
definitely
right,
will help
can you
our
guys
ARPU.
see what I'm sharing?
Yeah.
Yep.
Yes.
Okay, so this is transaction-based revenues from Robinhood's most recent quarterly report. So what you're looking at here is these are the actual people who are buying and selling, and how much the breakdown of how much their revenue comes from those different portions. So the bottom light green, I hate that they're all green, but the bottom light green is just normal equity. So this is buying and selling shares of companies. The middle green, lime green, I don't know what to call that, is options, and then that darker green on top is crypto. So if you take out Q2 of 2021, which is the ridiculous crypto craze, Dogecoin to the moon phase, right? Options make up about 60% of their revenues every single quarter. So somewhere between like 55 and 60% of their transaction-based revenues. So what we know from the previous quarterly report from Sofi is so their revenues are way higher than Sofi's, right? So Sofi last quarter in the third quarter only made $3.85 million in Invest. So in all of Invest, whereas their revenues are obviously much higher than that. But if you'd assume the same breakdown, where I would guess that SoFi's crypto is smaller. Well, I guess I don't know because they do charge fees on their crypto. But if you assume the same breakdown and you take that $4 million about revenue that we had generated last quarter, you'd be generating somewhere around $6 additional million per quarter. So it's not like it's going to be that huge. I would think that people, as they start to like the good thing about options is that it engages users is the thing, at least for me, right? I'm on Webull every single day because that's the thing that I trade with, and I sell cover calls and I sell CSPs or cash secured puts and everything else. And so since I interact with it more, I think that people will interact with their SoFi app more, the people who do trade options. And I do think that you get more engagement with SoFi Invest because of this. So I think, relatively speaking, my guess is that we'll get somewhere between like $25 to $35 million annually just from options. That's kind of a back of the envelope calculation, and we'll really know more like at the end of Q1 once they have a full, quarter of having options open. But that's just sort of a back of the envelope calculation.
And the
And
good
you
thing
even
is
said
it
that-
gives you the ability to possibly siphon users from these other platforms. So it could be big because SoFi has a much more dynamic offering than a Robinhood or a Webull. So could definitely see it happen.
Yeah, and especially whenever we do get level one options, Chris, I think you even said on Twitter, you would transfer your 2 brokerage accounts the second that they get that because you have no reason to be at wherever you are, Robinhood or something along these lines.
Right.
So if that's the case too, if there is more engagement and everything, and I think options, there's definitely more transactions per user than there is on buy and hold stocks. I think for the most part. You're on the app, like you said, more often, which allows for things like, the option to cross-sell into a lending product or something like this, where we actually do make, the bulk of our money.
So I don't want to be bearish, but it would take more than just this for me to move my accounts over. And I've said it before, I really believe they need to get a Thinkorswim platform or an E-Trade Pro platform to really get a vast majority of people to switch over. I just don't know how anybody uses Robinhood or any of those platforms. When you use Thinkorswim, you'll never use anything else. And probably the same for E-Trades Pro or the Fidelity one. It's just so intuitive and so in depth.
The problem,
You
Steven,
can't
the fundamental
understand.
problem with everything you're saying is that there's no confetti on Thinkorswim.
Yeah.
Exactly. I don't want
Yeah.
For
confetti.
me,
I want GDP data. I want all the different economic.
no. That's boring. I need the confetti. Okay. I wrote a cash secured put a month ago for the first time. I got my $25 of premium. Confetti. I was celebrated. I was happy. It was good.
On Palantir or SoFi?
On a different stock.
You're cheating
Okay.
on your two favorite stocks.
Yeah. Okay, so cool. So that was the options. Obviously, it'll be really good. We just got to see it fully get rolled out. Next up on the docket is student loans. Obviously, student loan moratorium has been extended till June 30th. There's some federal court in Texas that said Biden's $500 billion plan to wipe out $10,000 per borrower was illegal. And so Biden pushed the student loan moratorium, and he's asking the Supreme Court to take a look at it. Steven, can you start with your updates? And then I want to talk about the breakup of the court. Not to get super political, but I do want to talk about if we think the court is going to rule in favor of this. But can you talk a little bit about your updates?
Yeah, so this is not political. I never try to share political views. This is strictly the facts based on the information that we have. So the back of story of it is that on 8/24, the administration came out with their student loan plan, and it went to federal appeals court, issued a stay, which temporarily blocked the administration's plan to forgive billions in federal student loans. The stay was in effect while the Eighth Circuit Court of Appeals considered a motion from Republican-led states to block the forgiveness program. It came 1 week after borrowers started applying for forgiveness loans in the amount of roughly 22 million people. So on 11/14, Reuters reported that a U.S. appeals court extended a block on Biden's plan to cancel hundreds of billions in student loans. The St. Louis-based 8th U.S. Circuit Court of Appeals issued an injunction barring the U.S. Department of Education from following through with the statement from 8/24 regarding student loan forgiveness. The most recent, on 11/22, the Department of Education extended the moratorium into 2023 due to the decision made by the U.S. Appeals Court. And on December 1st, the Supreme Court agreed to hear arguments over President Biden's student loan forgiveness program sometime in the winter. And the projection is that a decision would be issued late June. So the exact quote from the Department of Education, exact quote, payments will resume 60 days after the department is permitted to implement the program or the litigation is resolved, which will give the Supreme Court an opportunity to resolve the case during its current term. If the program has not been implemented and the litigation has not been resolved by June 30th, 2023, payments will resume 60 days after that. So that is where we are.
So
Okay. Riley, go ahead.
So what you're saying is depending on what the Supreme Court decides, the student loan moratorium could end way sooner than we were thinking.
I'm not a lawyer. None of us are lawyers. I am sticking straight to what was reported from the different courts and from Reuters. And I don't really know how to interpret this based off of what we've seen. I mean, the Department of Education was pretty concrete that if it's not resolved by June 30th, payments will resume 60 days after that. So that puts us August 30th.
So I know that normally they said that they're going to hear oral arguments in February. And usually the Supreme Court has like I forget a recess or something for the summer. So usually if they hear oral arguments in that term, they rule on it during that term, and that term ends on June 30th. So I would assume like that I'm sure there's some exception. Again, I'm not a lawyer either, but the vast majority of cases, they will rule on it during that term before their summer recess or whatever they call it.
Yeah, I think
and so I would expect that one way or the other we'll know before June 30th, right?
Yeah, the big question is, does this get pushed out again? I mean, the Department of Education is saying that no matter what, 60 days after June 30th, even if this is still in litigation, okay, they can say that now, but is anybody going to hold them to that? I am looking at 2023, and this is my own personal speculation. I am not looking for student loans to come back in 2023. I am beating that into my brain that this is an investment where student loans are not coming back in 2023. And if they do, I'm going to be extremely happy from a business standpoint for SoFi. But I'm not getting excited over anything right now because anything can happen.
To think about it from the, or Tanner, go ahead. You got it, Tanner.
I was just going to say, do you think that SoFi is even going to guide for student loans coming back in 2023 at
No,
all?
they'd be crazy to.
Yeah.
If they're going to be crazy to put any guidance in, and they're going to, if I was Noda, I would go by what I know, and that this has gotten pushed off 4 or 5 times already, and just guide for
8
what
times.
it is.
Yeah,
and
8.
then you can, and then you can revise. If it looks like this is going to come back, you revise. You don't get hurt doing that. You get hurt by saying, okay, it's going to, worst case scenario is August 30th, so we'll get 4 months of originations. And then it doesn't happen, and then you have to guide down. They're not going to do that.
Well, so what did you think about what happened with 2022? Because what happened whenever, it got pushed another time, whenever it was final extension, then got extended again. In 2022, Anthony Noto came out and they said, well, we're not guiding for student loans at all in 2022, which seemed to be the case until Q4, which now they're doing conferences and saying that they did put student loans into the guidance at the back half of Q4. So now they're expecting to fall behind in Q4 because they did do what they said they weren't doing. I don't know if anyone saw that. That was Chris Lapointe speaking at.
Did he say that publicly, or was this like just conversations in between the company? Like,
No, it was at
No,
the
no,
Credit
Credit Suisse, the technology conference that just happened.
oh,
I'm
During-
hoping he misspoke.
During the no, they have in the quarterly earnings reports, you can go back and they say that they expect a small originations bump near the end of Q4 because they will be resuming in January. So that was public. They've talked about that previously before the Chris Lapointe conference this week.
And that could be like what happened in Q1 when everybody thought it was going to end, and you saw the uptick in Q4.
Yeah, it went.
And look, maybe they baked that in, maybe they didn't. We'll see in a month or so.
The thing is that even if they did bake that in, this is just my personal opinion. I don't think it affects the revenue for Q4 very much because student loans have a lag. Well, all loans, right, have a lag between the time you originate it and the time you start getting interest and then the time you sell it. And so I do think that they would have sold a few more loans in Q4, student loans, than they will now because they'll be originating less, right? So in order to make their balance sheet look the way they like it to look, right, they keep a level of student loans on their balance. But I think for the most part, it's not going to affect it that much. That's just my take.
So
I would agree.
I think that transitions pretty well.
All right, let me give one point in here. I think Biden obviously did this to get some votes, right? We can all admit that's not the most political thing to say. Like this 10,000 thing was done before the midterms explicitly. 2023 is right before 2024. So if he's running again, I think it's safe to say that the administration, I think, Stephen, you're correct on this, that we shouldn't guide for student loans, because what if the administration just says, no, we're going to figure out how to still do something about student loans, even if the Supreme Court does whatever they want to do, because the 24 thing is coming up. So I think it just makes a lot of sense that we would imagine purely for political reasons, which is the nature of, sometimes you have to talk about politics and business, that student loans don't get resolved. And I want to spend like 2 minutes on, do you think the court rules that it's constitutional? I think given the nature of the court, this is a 5-4 that it's not constitutional at all.
I mean, if you're going by party lines, that would make sense. But
Even a 6-3 possibly.
Yeah, I mean, none of us in here are legal experts, right?
yeah,
Like,
we're not qualified.
I'm not a
I'm not
constitutional
gonna
lawyer,
speculate.
so
I'm not speculating on it.
Okay. So, all right.
All I'm going to say is that I am not incorporating it into my investment thesis. And just because it has been pushed back to possibly August 30th has not changed my long-term thesis. The stock and the company are two different things.
Okay.
Yeah, I'm not going to make a comment on if it's constitutional or not. But what I have been wondering is, let's say regardless of whatever the option is, if this was an emergency, to actually put the student loan repayment on pause. Is there any sort of guideline for whenever that has to come to an end, or that's considered unconstitutional, or even like, it just seems like the actual pause in payments is hurting just as much in terms of tax loss to states, whether it is unconstitutional or not. But yet that doesn't seem to be argued at all, that the pause part of this is actually, not
So
in
my
question.
understanding is that it's pretty crystal clear that the president has, if there's an emergency, so if there's a national emergency, the president has authority to pause student loans. Like
Right.
that's very clear. And so if the national state of emergency, which I believe is set to expire in February, expires, and then after that, so first of all, they can just extend the emergency, and who knows, right? Like that's really easy for them to do, so they might do that. If it does extend, or if it does end, and then I think if Biden after that were to extend the moratorium, then you'd probably be able to do lawsuits, because they'd say, hey, you don't no longer have this emergency clause that grants you this power. But I mean, again, we're prognosticating on stuff that
Yeah, but even then, it
don't
seems
know
weird that
anything
it's possible that it can go till June. And I mean, it makes sense, that timeline, but it doesn't make sense if it's considered an emergency or not.
Yeah.
If February is the cutoff, But I did want to speak, because we were just talking about, I forget, Chris was talking about, loans on the balance sheet, everything like this.
Are you getting into the topic?
Well, not topic. I just
So
want to know.
No, let me introduce the topic. If you're going to
You
introduce
don't
the
worry about it. You don't
topic,
worry about it.
you got to let me
I-
do the top. You got to let me introduce, because right here,
He's
hold on.
moderating. Let him moderate.
Hey,
I barely get a word in on this
Lending Club.
podcast. At least let me moderate.
Can you
We
say
have-
3 times fast, please?
We have a beautiful friend in the chat, friend of the channel. His name is Chris.
There he is. He's right there.
Chris is talking solar in the chat. I don't know why he's talking solar in the chat. We're talking about SoFi.
Because
Look,
I'm
Chris likes to throw it out there. He's getting a little spicy today on Palantir. Chris, we'll talk about that in about 38 minutes. 38 minutes. So don't worry about that. But last week, Chris, this was the day before Thanksgiving. Okay, Wednesday night. We're on a beautiful stream talking about SoFi, having fun. We're gonna be freaking millionaires in 10 years. And then Chris comes into the stream. He's like, "You guys are fucking idiots." Now he didn't say it like that, but that's what it felt like. Because his argument was that SoFi is a lending business, essentially. That's the majority of the revenue. Galileo is like, it's there. AWS, a fintech, that's kind of bullshit.
We are a lending business.
Right. So lending, right? He pulls up these charts that come from the Illuminati or some shit, basically saying that rich people don't need 12% loans. People that have high FICO scores, which is the main people that SoFi is targeting, even for student loans, which is why SoFi is in a horrible position, because they're not going to be able in a upcoming recession to be able to make the revenue they get from lending off these individuals, because these individuals aren't taking these loans. And he had these complex analyses to be able to make that argument. And me, Riley, Tanner, and what's the other guy's name? Tevis, were not able to effectively refute his argument. And the comments were very clear that we were not able to effectively refute his argument. So we have the next 37 minutes to get some analysis from some other people that could help us refute his argument.
So I just want to state first, because that's not what I was going into, but I was just going to talk about Lending Club buying back loans that they had originally originated. And then Chris and I were talking on Twitter about SoFi also acquiring about $1.3 billion worth of loans. But anyway, yeah, we can go into to Chris's topic, but I just wanted to talk about the risks of or maybe opportunities of what they're seeing, because everyone wants to talk about the risk, but as if we're buying back loans with no opportunity there, as if we're not going to get interest income from it. So that's what I wanted to.
Let's get into the Chris topic, then we'll get into your topic.
Sure.
The Chris topic is a little more exciting. So we have SoFi Chris here that is with us today. His @ on Twitter is there on his name. What is your response to Chris's bear argument around this loans situation?
All right. So, Chris, you're in the chat. You can let me know if I'm representing your arguments wrong. But I think kind of the two main things that
he's in the chat. Bring him on.
we could bring him on if you wanted to.
Chris, if you want to come on, open invite. You got it.
Please.
So I think the two main arguments were that, number one, it seems like, again, tell me if I'm paraphrasing this wrong, but the idea is that wealthy people don't take personal loans, right? So people who have these high FICO scores, who have a lot of income, aren't out there taking a 12% loan, because a 12% loan is a ton of capital that you're giving back, right? Like you have to pay a ton of interest on that. So that's the first thing. And then the second thing is that delinquencies are rising. We're on our way into a recession nominally. Lots of people are prognosticating that we're on our way into a recession, I'll put it that way. And so during a recession, delinquencies rise a lot. And if you've got a bunch of unsecured personal loans on your books, then you're in trouble, because as the default rates rise, you're going to have to acknowledge those. You're going to have a bunch of charge-offs. It's going to hurt your bottom line. It's going to hurt your top line, etc. Those are the kind of the two things that I think that he was trying to get across. So kind of on the first one. So I'm with him in that I would never personally take a personal loan at 12%. That seems bonkers to me. And I'm also, like, between my wife and I, right, we are also SoFi's customers, right? We're kind of there. We fit the mold of what SoFi is looking for in a customer. And but I've also never taken a car loan. I have a 6-month emergency fund, a bunch of other stuff, but that's not how everybody lives. So I think Chris's argument has this false dichotomy where he says you are either fiscally irresponsible and you won't be taking a loan, or you are not a high FICO score person, right? Like, or you're a high FICO score person and you won't take the loan because you don't want to make a dumb financial decision that costs you 12% interest. And it's a false dichotomy is the problem. So that there is a giant gray area in the middle with a bunch of people who are living paycheck to paycheck, who are making 6 figures, but still living paycheck to paycheck because they don't control their spending very well, right? And you can obviously see this because SoFi, like you said, they aren't cooking the books, and their quality of borrower is really, really static across time. Like in Q1, the average FICO score on their personal loans was 746. In Q2 it was 748, and Q3 it was again 746. So these are high quality people. They publish in the earnings report, they always talk about how their the average salary of those people, and it's around $160,000 or $170,000 per year. So these are high earners. But the thing is that just because you're a high earner doesn't mean you're not living paycheck to paycheck. So these people are still going out, they're going to bars, they're going to restaurants, they're traveling, they're going all over the place, they're trying to do all these things, and then they get hit with something that they didn't think of, or so they have a medical expense, or they want to do an add-on to their house, or they're putting solar panels on their house, or they realize, oh crap, I've taken a bunch of loans out on my credit card, so my credit cards are overdrawn, and I should consolidate that into a personal loan that has a fixed rate, because every single month my credit card's going up. That's the vast majority of the people who refinance with us. Same thing with Lending Club. So that's why the current rising rate environment is actually a tailwind for personal loans. And they've said this multiple times, and Lending Club says the same thing. They say that this is great as far as personal loans goes, because you can refinance that higher variable rate into a fixed loan. And so there's this third, I guess, cohort of people who are looking to make either better financial decisions or have been hit with something that was out of the blue that they didn't expect, and now they need loan. But they have high. So one of the interesting things that Chris LaPointe said this week is he said that they try to originate. They look at a person's free cash flow. It's not necessarily their FICO score that they're looking at when they originate a personal loan. They try to originate to free cash flow. And so you can think of this in the context of like technology stocks right now, right? You're right. And he brought this up last week. So Google doesn't need to be laying off 13,000 people. Meta doesn't need to be laying off 13,000 people. They are gap profitable right now. The reason they're doing that is because they're cutting down, right? So if I'm a person who's living paycheck to paycheck, but I'm making $160,000 a month, and now I want to install solar panels on my roof, I can take, a $30,000 personal loan, and now I just go out and I don't drink as much, or I don't, go out to dinner, or I skip one trip to, wherever I was going to go that weekend. So you have all this excess free cash flow that you could fill with a personal loan, but and that's what they do. So they take something up front to do a renovation or to get their money right by, refinancing all their credit card debt. And the numbers don't lie, right? Like I guess that's the bottom line, is that we know the FICO scores. We know the salaries of these people, right? They're not cooking the books. These things are publicly available. And so those are the type of people who are taking these loans. Now, I wouldn't be one of those people, but there are $6.8 billion of originations who exist from that cohort of people, right? They exist. They're out there. It's not one or the other. There's this entire middle ground. Anyway, anybody else's thoughts can say their thoughts as well.
Yeah, I was just going to say also, there's a definition for as you start to increase with wealth, you increase your expenses, right? Lifestyle inflation, and it happens all the time, very, very common. And I think it's hard, especially whenever doing financial planning and these sorts of things, that anyone would do anything other than the most optimal thing. But it's so true that people get themselves in sticky situations, and even though you have high FICO scores and high income, that you still need debt consolidation.
Steven, your thoughts on what Chris said and why there are these cohorts of people that still would take these loans regardless of their income?
Yeah, I mean, look, I'd rather Chris come on because he should have an opportunity to discuss this with us.
He said he's little spooning with his wife, so.
Okay. So
that's what he said. I'm reading the chat.
Steven's
he said he's little spooning.
Steven's the most rigid guy. He's like, I don't want to hear any of this nonsense.
So in regards to what Chris said last week, he is right from the perspective of that's his opinion. And he brings up some very good points. I don't think anybody can say he did not bring up valid points and things that should be considered. Where I would disagree with him would be Chris is very proficient with his capital. And he is probably financially more in tune than many other people.
He's not that proficient because he invested in my startup. So,
well, if you get Gary Vee on board, that may be the best investment he's ever made. But anyway, which I think you have a very good chance at, by the way.
Thank you. I appreciate it. Hopefully. All right, continue.
Anyway, the statement that he said that I'm really having a hard time with was about pulling the money out of a home and taking a home equity line, because not everybody has that option, because not everybody owns a home. In addition, not everybody owns a personal residence that's a single family house. Some people own a condominium, some people own a co-op. It is much harder to pull equity out of those two types of properties than an individual home. So there are reasons why people would be unable to pull equity out, or if they had a second mortgage on their personal home and just are not in a position to pull equity out. You never know why somebody needs to take a loan other than they need capital. And it comes down to what options are available to them. And at the end of the day, some people may not want to open up another credit card for whatever reason to transfer balance onto it. Who knows? But at the end of the day, personal loans exist. Every bank originates them. There's a reason they're out there. And if somebody is going to use it at 12% to pay off something with a higher interest rate, you're saving the spread. So he brings up valid points, but I would like to think that SoFi has some halfway decent actuaries that are building their models. And personally, I'm not too concerned about it, but that doesn't mean there isn't a right to be concerned.
I feel like this comment kind of misses Chris's point. Chris on the screen right now. So he says, so basically SoFi has a bunch of paycheck to paycheck borrows. Chris, isn't your point that you could be making $160,000 a year, but if you're installing solar panels, that's why you take a loan, which is why you're not living paycheck to paycheck, but you would still take the loan?
So I think these people are living if you had $30,000, it would make sense to pay for it and install the solar panels with your $30,000 that you have in the bank, rather than initiating a 12% personal loan. So I think these people are living close to. I think these people are living, for the most part, I think a lot of the people who probably take personal loans don't have a big emergency savings fund or other things like that. That would be my impression, but I don't know.
Amit, could you share? I have it up. Amit, share my screen. There you go. Tell me what to do, Steven, here.
I mean, I just think that, and I don't know if this information is credible. I just found it seems pretty good. But if you look at this, 125 million Americans live paycheck to paycheck. 63% of Americans live paycheck to paycheck as of September 2022. Let's go down to where you are. So leave it right there. Of those who earn over $100,000 a year, 40% live paycheck to paycheck. Of those who earn between $50,000 and $100,000 per year, 53% live paycheck to paycheck. If you go down to where there's the purple highlight, there's purple highlight on mine, not yours. Go right under the pie graph. Go up a little bit, please. Right there, right there. So 21% of U.S. adults struggle to pay their bills. Of those who earn over $100,000 annually, 12% struggle to pay their bills. I mean, these numbers don't paint the greatest financial picture. And these are numbers that many people in the U.S. would classify as a high earner when you start talking about six figures. So there is definitely reasons why people would take personal loans. And you can speculate all you want about what those reasons are, if it's a good reason or a bad reason, but at the end of the day, every bank has personal loans. They originate personal loans, and this is a business in America.
Yeah, I think it's interesting because when I think of paycheck to paycheck, the mind I get in my head is someone who's, for lack of a better word, like lower income, right? But you could be making $250,000 a year, living in Mountain View, California, working at Google, still being paycheck to paycheck because your lifestyle is just a little bit more enhanced, right? And I think that's where you can kind of have the financial flexibility to take a 12% loan because you have this really big salary, even if you are living paycheck to paycheck.
What I'd like to know is how many adults own their residence versus rent. That's what I'd like to know. Because right there, you take out a percentage of Americans that don't have the ability to tap the equity that they've built in their home.
Right.
I also want to talk about how, lending to people where there is a chance at default or a percent that they are expecting to default isn't necessarily a bad business model either, right? That's part of the lending game, is that there will be defaults, right? You look at a company that I used to cover called Go Easy, right? Look at their financial statements. They cover the highest of the high whenever it comes to risky people in lending. Now, they charge an interest rate to go along with that. I mean, 40% interest rates on their clients. Now, everyone thought they were going to go out of business whenever COVID hit, and then now, and I think Chris is asking me for the link. Just type in Go Easy. GSY is their ticker.
No, he asked. I sent it to him on Twitter. He wants to come on the pod.
Yeah. So they have.
But Tanner, why is that a good business if they default? Why is that a good business?
Hey, Chris,
I'm
check
not saying
the private
it's
map.
good that they default. I'm saying it doesn't, like, if their interest rates are set to a point where they can pay for the losses, then that doesn't mean that it's a bad business model. They are expecting losses.
Gotcha.
I'm
it's
not
almost
saying
like Target
losses. I'm
expects
saying
people
that it's part of the expected lending game, and the same with the idea of unsecured versus secured loans is that if we have secured loans, then the interest rates are going to be lower. And if we have unsecured loans, then the interest rates are going to be higher to pay for the people that default. And so this is all part of the game. Whether you say that we're going into impending doom is kind of like an, indefensible argument because it's just someone's opinion.
Gotcha. Chris, you were going to say something?
So I guess, do we want to move on to kind of the second part of this, which is the delinquency argument?
Yeah, let's go ahead.
All right. So let me pull up the chart and I'm just going to share.
While you're doing that, I can echo what Tanner's saying. It's kind of like Walmart or Target expecting people to steal from their stores. They kind of have to bake that cost in, right?
Exactly.
They know they're going to sell so much. Some people are going to steal, and it just becomes a sunken cost at that point. Let me read some super chats also while we're doing this. We have Tyler Binder. Oh, is this Binder from the Reddit dude? I don't know. Okay, cool. Worked at a bank. High earners had next to nothing in savings. High earners spend everything like it's a lifestyle. That's true. Steven told me he spends a lot of money on coffee, so he is a high earner in my opinion. James says, BTW, thanks for this weekly SoFi wrap up. This represents a big investment for me, so I appreciate the source of insight. Awesome.
So can you guys see my screen now?
Yeah, hit the % button if you can.
All right, we'll just go into like full. Does that work? Can you see the full thing? Okay. All right. So this is the exact same graph that Chris showed last week. So this is the delinquency on consumer loans in all commercial banks for the last, 20-ish years. And the concern is if we are going into a recession, we're going to see something like the last 2 recessions, where delinquency rates are going to go way higher than they are right now, and especially because we are way lower than historical mean, right, on delinquency rates. So this is the argument is now we're going to be charging all these off. The banks are going to. We've got these unsecured personal loans that are really high risk, right? And now all of a sudden you're going to see everything topple down. So first of all, this data includes all consumer loans, which includes really low FICO subprime people, and it also includes credit cards, which have higher delinquency rates than personal loans. So the more interesting data is this. This is from TransUnion. So they actually didn't put out an article, and I can link it or send the link to whoever's interested, where they said, okay, let's go back. People are really worried because more people are taking out personal loans now than any time previous. And if we are on the cusp of a recession, the exact same argument that Chris made, then these people are going to start defaulting at a much higher rate, and we're going at a large credit risk. So they went back and they said, let's back test this. Let's look at 2007 third quarter portfolios of unsecured personal loans across all banks, and we'll see how they defaulted based on credit performance. And you can see the credit performance down there at the bottom, right? So what qualifies as subprime, near prime, prime, prime plus, and super prime. And they took a look at this data, and this is really interesting because this corresponds to the exact time that you see here with the biggest peak in delinquency rate on consumer loans. Now, SoFi's average FICO score for the loans, and I guess the other argument he made last week that I do want to mention right now is he said, well, why do they do FICO score at time of origination? Because as they default, they're going to get lower FICO scores. TransUnion on this data that we're looking at here did the same thing. So this is based just on the FICO score during the third quarter of 2007 when they originated the loan. And then they looked at what happened. So if you look at this, pretty much our average FICO score is right in the middle of prime plus. We probably have a little bit of prime in there and a little bit of super prime, but the bulk of the loans that SoFi is originating are going to fit in that prime plus category, which means that over the next 3 years, if the trend now follows the worst trend ever in the history of like the great financial crisis, right? It was a crisis that affected all banks. Then you get about 1% of your unsecured personal loans defaulting in that time. That's cumulative from Q3 of 2007 to Q3 of 2010. So a lot of the bear arguments for SoFi, at least as far as I've seen, come down to the same thing. So you make a rhetorical argument, and it sounds really, really interesting and compelling. And then I go back and I look at the data, and I think, it's not a big deal, because the rhetorical argument doesn't hold true when you look at SoFi's at the quality of their borrower. If you look at the default rates historically, if you go back and actually test this theory or the rhetorical argument with data, it's the same exact thing. So people get all hung up over, and I can stop sharing now, but people get all hung up over whether the fact that SoFi is using this held for sales in accounting versus held for investment. It's become this giant flashpoint on SoFi that people are like, oh, but they're not taking the credit provision. So normal, I guess I can get into this if we want to, but we probably should because they've been asking about this in the chat. But normal, so a bank can originate a loan and they can do one of two things with it, right? They can either hold it until maturity or they can sell it. And the way that you account for that in your accounting is different. So if you hold the loan for maturity as a result of the great financial crisis, they have amended the way that you're supposed to do the accounting. And so the accounting is done, they take what is called CECL provision, CECL, I can't remember. It's like expected credit losses. And the idea is upfront,
current
if I
expected credit loss.
There
CECL.
you go, current expected credit loss. So upfront, if I originate $1 billion of loans, and I assume based on data, and they had, you use empirical data, and you say, based on the credit score that we're originating, 7% of these loans are going to go into default over the life of the loan. And so then you set aside 7%, which in the case of $1 billion would be $70 million, and you take that as a CECL provision. And so that's what you do if you're holding it for investment. If you're holding it for sale, you don't take CECL provisions. Now, SoFi holds everything for sale. But with held for sale loans that you originate, every single quarter you have to reevaluate them at fair value. So you say, okay, I've got this $1 billion of loans, but rates went up, and so now those are worth less because I can't sell them for as much. So you take a hit on that. So there's two different ways that you can go about looking, or that you can do accounting, and both of them are accurate. Both of them are generally accepted accounting principles. Both of them are the exact same. Well, not the exact same, but both of them are like fully above board, I guess is the way that I would say it. But people get all hung up on this, and they're like, SoFi's not taking CECL provisions, they're taking on all this risk. And then, so I wrote an article about this.
Let me
and
just
I'll
let
probably
me bring in Chris now, because here, this is the man who left his spooning with his wife to come make
Guys.
this argument.
Yeah, no, he should be here.
It's Captain
Chris.
Solar. Look at this.
Hey, Chris, could you real quick just summarize the two different charts that you showed, and like what I mean, could you just explain it to me like I'm a little bit of like a 5-year-old here?
Yeah,
'Cause
so it's
I
got
do
to
have
be
a hard
Chris
time.
and Darth Chris. Okay, so
and then Darth Chris can
Yeah, Tanner explained it pretty well. I was actually listening with regards to defaults going higher, right? Basically, that was one of the things that I was trying to show everyone, which is right now we're not nearly in the recessionary environment that, you know, we were in the past. And in the past, when recessions usually hit, you're going to see delinquencies, you know, pretty much go up. Now, the thing is, if you take your loans, take them off the balance sheet by securitizing them and everything else, that's risk that's not on your balance sheet, right? Whereas right now, SoFi has a lot of stuff on their balance sheet. They have a lot of personal loans on their balance sheet. So basically what happens is the interest income that they get for those loans, they use that. And then all the non-performing loans, they have to subtract against that. So basically, if let's say someone doesn't pay for 90 days, guess what? That's a non-performing loan. So what are you going to do with it? You're going to keep it on your balance sheet saying, oh, this is a non-performing loan? No, you usually have to take a write down. Now, the thing is, the more people that don't pay ends up being really bad thing for SoFi, because now it just digs into what's happening to them. On top of it, the cost to borrow capital is steadily rising also, right? So if you look at like
so what, Chris, can we get into your response? What was your issue with what Chris Heugermeister said?
I actually didn't get that part because I was setting up everything. So what were you trying to say, Chris? Sorry.
All right, I'll share again.
Because I think people know your bear case and you just explained it clearly, but Chris's argument was a little bit against your point.
Okay. Can you guys see my
a
screen?
quick summary just for the case of time.
Okay. So this is the chart you showed last week, right? You know this one. This is from TransUnion. It's their data. So for personal loans that are originated in the third quarter of 2007, this is how many. So that vintage, this is how many of those defaulted. So you're right in that defaults were increasing across the board, but they're decreasing significantly more in the subprime area than in the prime plus. So SoFi's originations are 746 is their FICO score, which is right in the middle of prime plus. So this is like the absolute worst part of what we're looking at here between 2007 and 2010. And when delinquencies went up. But the type of loan that SoFi originates is a prime plus loan, which means over 3 years. So between 2000, this same cohort, so all these loans that were originated across all banks from in the third quarter of 2007, only 1% of them had defaulted by the third quarter of 2010.
So, Chris, I'm totally with you on that. My question is this: how many prime borrowers are borrowing at the rate that's out there right now? Like, think about it this way logically. Like you just said, okay, listen, I would never borrow at a 12% interest rate, right? Because you're somewhat financially savvy, you know what's going on. Most prime borrowers that I know are at least on some level of financial they're at least somewhat financially literate to know that, hey, you shouldn't be paying double digits for a loan, a personal loan. I mean, yes, I get it. The argument is, well, you know what? There's a lot of Americans that live paycheck to paycheck. Well, guess what? They're probably the least likely that you want to borrow money into during a recession because they have no emergency funds. You guys said it yourselves. They are probably the most likely to default in case something bad happens. So yeah, I get it. The credit cards and all this other stuff that they're doing, credit card consolidations and everything else. But that doesn't erase the debt. That just makes things, that gives them an additional lifeline for like another 6 months, 7 months, whatever. Especially if you lose your job and you've had high income, like it's really hard to figure out where you're going to end up being able to financially support that. So my thing is, I don't necessarily trust that a lot of the borrowers that they're saying that are prime. And I'll tell you why. If you go to 2017, and this is something that I'll show you guys here. Let me share the screen.
So can I answer that real quick?
Mm-hmm.
So, but the argument you just made would also have held true in 2007. So these high prime plus borrowers in 2007 would have exactly fit the description of what you described, the high FICO borrowers in 2020.
Hold on one second.
Okay.
Sorry. Damn it, it's behind a paywall, but
freaking paywall, man. Freaking paywall. But I'll summarize while
you
you're
can do it. You can pay it. Just come on.
Yeah, Chris, you don't need a 12%.
Get you a
subscribe to
loan.
Bloomberg. Screw that nonsense. No, but basically what happened
Yo,
was
log into my account right now. I pay $1.99 per month. I'll send you the password.
Yeah, I do too, actually.
Let me see. No, it's not the student loans. There's the personal
I got it
loans.
on some Black Friday deal.
They ended up having a lot of trouble. Hold on. There.
But in 2017, they weren't underwriting to the same quality of borrower. It
No,
was under
they
the
were.
previous CEO.
Dude, I'm telling you right now, back then they used the same argument that, hey, listen, we have wealthy borrowers. They have all good FICO scores. It was the same exact argument that they're making today, right? That's the problem. That right now, everything that they're saying, like, oh, we have high FICO score borrowers. We have, wealthy individuals that we're lending money to. Well, guess what?
Well, all right, hold on. Let's not use the word wealthy because we should really define what we're talking about here, because making six figures is not wealthy.
Right. Wealth means that you actually have assets that you can actually borrow against. So once again, people with a lot of assets, they're not the type of people that are like, oh yeah, let me go take out a high interest loan. They have,
but they are. That's the point. Like SoFi's not cooking their books. They have people who have salaries of $160,000 and FICO scores of 746. Like you can't dispute that. And those are people who have been paying their bills, who have you don't just get a 750 FICO score because you're defaulting all over the place, right?
Chris, and I understand that, but guess what? That's at the time of origination, right?
And so was the data I just showed. That's my point. That 2007 data was at the time of origination.
Right.
And 3 years later, though the exact type of person that you're describing, so the people who are taking out personal loans, who have these unsecured personal loans, who are at such a high risk of defaulting, only 1% of them had defaulted.
Okay. But I'm still telling you.
And that's not my data. That's TransUnion's data.
Right.
So I'm going to step in for a sec. So, and I'm trying not to laugh because Chris actually put Darth Chris in his name, and it's hilarious, by the way. So I will refer to him as Darth Chris. So Darth Chris.
Well, I had to distinguish between the other Chris somehow. So this was a good way to do it.
Okay. Fair. You also have a K. He has a C. You could distinguish that way, but okay, sure. Darth Chris brings up some very valid points that everybody should.
No, and he does. They're very this is something that we need to be discussing. This is a bear case that everyone should be
100%.
Well,
nobody can speculate and say that if we are going to go into a recession, that it is going to be worse or mild than 08. Nobody can speculate that. I mean, we'll know in a year from now, a year and a half from now. So anything can happen. On the other side, the data that Angel Chris has provided for the SoFi fans.
I prefer Jedi Chris.
Jedi Chris, sure, we'll stick with the Star Wars theme, has shown what happened in the financial crisis. And we're going to have to see how it plays out. I would once again like to think that SoFi has actuaries that built this into a model, and based on the model their actuaries created, the loans that they are originating fall within their profile of risk. And addressing one of the things I addressed before Darth Chris came on was that not everybody is as proficient as you with your capital. And not everybody owns their own home and has that ability to tap a home equity line of credit. In addition, individual homes are not the only type of home people could purchase. You have condominiums, you have co-ops. It is much harder to pull out a home equity loan on those types of assets due to board restrictions and capital restrictions because it's a different type of mortgage. So there's all different reasons why somebody would need to tap a personal loan, especially if they don't have the ability because they don't own their own piece of real estate or have different restrictions than owning a personal home. So you got to take it with a grain of salt with just tap the home equity line, because not everybody has that ability or the looseness of a personal home versus a co-op or an apartment.
Yeah, and I think you kind of have to pick a side whether you want to, you know, I don't think you can say people aren't buying these loans and also they're not cooking the books, because you know, more and more people every single quarter are taking our loans, and if you do trust the 10 Qs, then they are, you know, 160,000 plus incomes and do have those FICO scores. So if those people do not take those personal loans, you know, people such as yourself, Darth Chris, then our 10Q is wrong. You know, it can't be both.
So let's address that real quick, Tanner. Because I don't
Well,
think
but
Darth
before you do that,
actually
unfortunately, one of the times I think that this is where I don't know if there is a way to dig into the bonds and the debt, the personal loans that they have. All right. Like I don't know if there's a way that we can actually go in and figure out what SoFi's personal loans are and what the credit, like them just saying, oh, we have high income borrowers. This is the average, this is the average FICO score, all that stuff. That's great. I agree with you. But guess what? I wish there was a way that we can actually look at that and see what the borrowers are, what their incomes are, what kind of debt that they have, what kind of debt limits that. Like, if you guys remember in The Big Short, like when they was like, okay, let's go and see if there's actually a housing bubble, because whenever you get into the situation of this dogma that, oh, this can never be wrong, like everything is perfect, this is a AAA rated bond, everything is fine, that's when you really have to be a little bit skeptical and say, you know what, do I trust these guys? And I right now am not saying that they're cooking the books at all. But what I'm trying to say is I don't trust the numbers as much as that, because it's just it's unfathomable for me that you're running a business, right, that isn't impacted by higher rates at such a high velocity. And the fact that all of these loans are staying on the books is a bad sign, because that means that investors are saying, wait, hold on a second. I don't want your loans that you originated. Take them back, right? And that's the same thing with Lending Club. At least Lending Club is, you know, keeping money on the side in case of these defaults. SoFi isn't doing that. They're keeping all of this on hold for sale. That's the problem. Why aren't they provisioning some capital or some cash for delinquencies? That's the question that I'm really puzzled by.
So before you two answer that, because I know both of you are chomping to answer that, and I'm not going to answer it, even though I'm probably going to say the same thing you guys were. I just wanted to make sure Chris had an opportunity to say his piece about he does not believe they are cooking the books. It's very important. I don't want anybody to get the idea that he is out here saying SoFi is committing fraud and cooking the books. So Chris, one more time, just say it again.
Yeah, I'm not saying SoFi is cooking the books. Okay.
So let's just make sure everybody understands that.
Yeah,
very clearly.
but
And
the underlying bonds.
yeah,
because then Noto is never going to come on the podcast. So we need to make
he wants to see a larger subset of information about the loans and get much more granular on detail.
Yeah, I just think the fact that no one is taking the student, like right now, no one is taking those securitized loans and they're actually returning them. That's like a red flag, right? Because if you have all these borrowers paying at 12% interest rates, dude, people would be lining up. Investors, private investors, be like, wait, you're getting a 12% return on high FICO score individuals? Yo, let me get some of those loans. But that's not happening, and they're all staying on SoFi's books. Why?
Well, they're not returning the loans. They're selling loans and purchasing them back, depending on whatever metrics that they're looking for. You know, depending on Chris brought up this point of, you know, the highest amount of time, and I'll let Jedi Chris describe this better. But when default rates happen most in an actual loan versus you know, SoFi actually being able to buy back that loan whenever it's considered or deemed safer. Now, obviously, that's if you believe what they say. Not saying you're cooking, but like if we actually go and look inside those personal loans. Obviously, we don't have that you know, that data.
So can you share my screen?
Yes. Yeah, I got it.
All right. So Chris, I wrote it's like a 4,000 word article that addresses exactly what you asked in detail. Let's. I obviously don't have time to go through all of it in detail. We're up on time right now. I don't know how long.
We can do another 5-10 minutes. That's good.
Okay. So here we go. The reason you can either choose hold for investment accounting or hold for sale investing. The reason that SoFi chooses hold for sale accounting is because they don't hold to maturity. Like it's pretty binary. You can choose what you do. But so here's the point. This is the loan maturity schedule from the last 10Q. So we have, like it shows here, so this is in originations, not fair value. So it's not exactly what you'd see on the balance sheet in terms of the total that you see on the right. But they've originated about $6.7 billion worth of personal loans. Of that $6.7 billion of personal loans, only 100 million of it, or less than 2%, is due in the next year. Student loans, it's even more but it's even more clear. They have $3.9 billion of loans and only 7 million of it. So it's like 0.02% of their loans go to maturity in the next year. So the reason
Is
that
there any
they're
way for you to zoom in, by the way?
Probably. Is that better?
Perfect. That's great.
Except for you can't see the labels on the right. There we go. That's better. Okay. So the point is that the reason that they do hold for sale is because they're going to sell these loans. So SoFi, at the rate they're originating, so they're originating $2.8 billion per quarter. At that rate of origination, they will cycle all of these loans in about 7 months or 8 months. So they cannot hold them on the books longer than 7 or 8 months. Now, the reason that they're extending the holding period, we'll get to that in a second, but it's the same thing with student loans. So student loans, they're cycling about once a year. So the reason that they're using this hold for sale accounting is because they're like 98% plus of their loans are going to be sold. So that's why they use it. Unlike Lending Club, who has this hold for investment model and purposefully sells those loans. Now the second question is, are they actually going to be able to sell those loans, right? And that's, in my opinion, that is the biggest risk. And that's the one that I don't know exactly what the, like, sort of what Stephen was saying and what you were saying. If we are going into a recessionary environment, then there's going to be rising defaults. Like they've talked about that, and there will be. And the other thing, the thing that's actually probably more important, and I'll share something else, that's why I'm scrolling down. But the thing that's actually more important is that demand from investors, so hedge funds and other banks and people who buy securitizations, does dry up in this environment because they don't want to take on the risk of a loan that might default, right? They kind of want to wait it out. The thing that SoFi has going for it is a couple of different things. So number one, so these were AAA bonds that these were personal loans. This is their only securitization from the
Zoom
last.
in if you can.
Yeah,
Zoom in
will
if
do.
you can.
So this is the only securitization that they've done in the whole last year, and this came
Wait, before
on
you continue, I just want to ask one
November.
thing.
Yeah, go
Even
ahead.
though that says 440, how much was that for?
This is 440 million.
Right.
No,
but
I think it was something like 660 million or something.
Mhm.
Oh yeah, because they still keep some of them on the books. That's how a securitization works.
Right. But here's the thing. So this is the weirdness that comes around. Okay. Even though the face value is almost 600, they have to place this giant buffer in the middle so that this way investors feel comfortable enough. This is like a way to get a AAA rating that's, I hate to say this, but kind of weird, right? Like this is the same thing that was happening with the bonds when the mortgage-backed securities, where if you remember the Django thing that, what's the name, that they showed, that this entire thing wasn't just full of all AAA rated mortgage bonds. It was full of some double Bs, some double A, some A, some double Bs. That's what I'm seeing right now. That because of the diversification, they're getting a AAA rating. But I don't think that this is a AAA bond. I really don't.
Do you think
But
the
that's
large? Do you think the
Go
large discount just simply comes because we're getting a full payment of 440 million instead of waiting the 15-year terms that it could be across the loans? Like there has to be a large discount because we're not waiting out the terms.
No, I think that there's an inherent risk with this bond. That's why you're getting such a big discount. All right, you're basically taking, like SoFi is taking most of the risk in this. Look at the tranches. Open it up, look at the tranches on which they have different things, right? And see which tranches SoFi has to cover by itself in terms of risk, right? Because that's what's going to happen. This is something that's like a waterfall where AAAs are going to get, like, in the mortgage bond, the AAAs are going to get paid first, and then it's going to go so on and so forth, with SoFi being at the bottom of that. Like, the fact that they have to give such a big discount, and not to mention, just look up the other securitizations they've done earlier, about a year or 2 years ago, and see what kind of buffer that they had back then, because it's nowhere near the buffer that they had to provide for this securitization.
But the reason for, well, part of that is also that they don't securitize things anymore because they sell wholesale loans. So they sell to wholesale buyers instead of that. That's the reason that this is the first securitization this year, is because they don't use the ABS market very often.
The fact that you have to provide almost a quarter of the bond as a buffer, it's not a good sign. That's all I'm saying. I'm just saying, be skeptical. All right. That's all
I am
asking.
skeptical, and I have gone through most of the filings, and we don't have time to do that on the pod.
And Chris, you can look at the filing and see the growth of those personal loans also that they have on their balance sheet. It went from
I definitely have.
Yeah, it went from 2 billion to 6. It was like, whoa, what the hell? And it's in less than 6 months. That's the other problem. Like, I could understand if it was a much longer period, but it was a very short period where all of this stuff came around. So,
hey, but can I answer that real quick?
Yeah, go for it. Yeah.
So let's see if I can find it where I describe it. So here's the thing: is that they forecasted this ahead of time. So if you in the first quarter of 2023, I'll stop sharing this and we'll just talk it through.
But just pull up the 13. Just pull up the report. They're the last 10Q.
The 10Q.
Pull up the chart that I made that shows all the originations. That's the best line graph you're going to see on the growth.
So the growth is high, right? But that's not what we're talking about. We're talking about the amount that they're holding on the balance sheet, right, Darth, Chris?
Yeah.
So the thing is that, so in first quarter of 2022 is when they got the bank charter. And at that point they said, hey, we're going to extend our holding period from 3 to 4 months to 6 to 7 months. And when they did that, they had about $6 billion of loans on the books. So if you just said, okay, if you're extending that from 3 to 4 months to 6 to 7 months, you're going to go from only having $6 billion on the books to $12 billion on the books. That's pretty easy, right? Because you're doubling the length of holding time. And then if you say, okay, so I'm starting at $6 billion in first quarter, I started originating everything in the bank in May. So even though they got the bank charter in February, they weren't originating all loans until May in the bank. And then you're going to build your balance sheet for the next 6 months. And so by the time you get to parity, it's 6 to 7 months later, which is November or December before they get to parity. And if you just draw a line and you say, well, if I'm going to start at $6 billion and I'm going to end at $12 billion because I'm doubling my holding times, then right now you'd be at about $10 billion of loans on the balance sheet, which is exactly where they are. So they forecasted the exact amount that they were going to extend their loans by, and we're right in line with that number. Now, again, I do want to stress that there is risk in that. So let's say we get to the first quarter of 2023 or the second quarter of 2023, and there's not enough demand for their loans from debt investors. Then at that point, it will be difficult to offload those loans, and you won't be able to originate as much, right? So SoFi kind of uses their balance sheet as like a shock absorber, right? So they can originate loans up into a point and then they have to sell it. And if they continue to originate loans at the same rate and they're not offloading them off the balance sheet at the right rate, eventually they'll get to the point where they're capital constrained. They're not there yet, and they still have a ways to go. And that is, to me, the biggest risk. And the part of SoFi and the part of this whole thesis that I don't feel that I know really well, because I have no special insight into whether or not the investors, like debt investors, so JP Morgan and hedge funds and these other people who are buying these personal loans, if SoFi comes up and says, we're going to sell these loans, and they say, no, I'm backing off. Now, they are insulated against that because they have, if you're going to buy an Upstart loan or a Lending Club loan or a SoFi loan, you're going to buy a SoFi loan because they're way higher quality than the other ones. But that doesn't necessarily mean that the demand is completely there. So I mean that to me is the biggest bear case. The problem is that I don't really know, and it's really difficult to tell until we get first quarter of 2023 numbers, it will be impossible to tell how much demand there is. I think it was a good thing that these loans, these $440 million of loans, like they sold in 3 days. Like it was really quick. And there's loans that have been, on the ABS market for 3-4 months that haven't sold.
And that's something that I wanted to add as well, is that, saying that, there's a large buffer in our ABS market or what we're actually selling, or what we're discounting for that sale is, that's a fair statement, but what is it against? Like, is this a larger buffer than what else is on the market? And do we know that? What's the average based on the actual yield that we're offering and the terms of the loans versus what we're actually offering? So saying that it's extra risky is just going up against what SoFi has to say, because obviously the same people that are offering these loans are also expecting losses from those loans. Are you expecting larger than what they're expecting? And is that larger than what the total market is suggesting? Because if it's, it's just one person's word versus another at that point. If it's to say that it's riskier without saying that the competitors don't have better rates than us.
Well, look, you have to go by the information that's given. And anything else is pure speculation.
Right.
Especially when you start talking about it being AAA, but maybe there are other things in there and it just has such a wide variety that's classified as AAA, like what happened back in 2008. So until we see, and they may never publish that information, until we see a data-driven analysis of what each of these bonds make up, it's very hard to come up with that answer. So I think we have to go with what they are saying, and you can be as skeptical as you want. And Chris brings up a very good point, and it's a great bear case as to why people should really take that into consideration, because it's a risk, especially if even half of what comes true that people are speculating for 2023 and 2024, it's a concern. But at the end of the day, given the data that we have to go on based on what happened in 2018, 2008 through 2010, it's not as bad, my opinion, as what it seems like. And I'm personally willing to take the risk because I look at this as a very long-term investment, and it's either SoFi's going under or they're not going under. I'm not selling this in 6 weeks or next year. And my investment is on 2030, not 2023. I'm operating that student loans aren't coming back in 2023. I don't care at this point. If SoFi doesn't go under, I would say the chances that they're going to do pretty well is pretty good, but you're going to have to wait a couple of years. So do you want to lock up your capital for a couple of years? For me, I do, because I think the juice is worth the squeeze. But everybody has to make that own decision for themselves.
I think we'll have to do another pod continuing all this, because Chris, I know you got some numbers, but we have
I was trying to find out where the average. So even the 12% that we're looking at, it's an average, right? There's a range of. Hold on.
Yeah. By the way,
we'll do another pod because we got to go. But Chris, real quick,
earlier,
Chris, you're not shorting the stock, right?
No, I'm not.
Okay,
it's so down, and dude, this is the one thing about investing that people have to realize. One thing goes right and in their favor, this thing could skyrocket tomorrow. Okay, yep. That's the key. When you have something that's super undervalued, and like I said, my theory could be completely wrong. Don't say, oh, Chris Patel, he's absolutely right. He's the smartest guy on the planet, so I'm not going to invest in SoFi. Clearly, don't do that. Like, if you believe that this company is telling the truth, by all means, go right ahead. And if their business model works, a guy like Anthony Noto, who I'm telling you, this guy is buying a ton of shares. That is a very, very good sign. No one that's predicting a company is going bankrupt is like not buying their own. Like, CEOs buying shares of their own company is a very healthy sign. That is the biggest form of shareholder alignment that you could possibly get, right? So I would say that in all possibilities, I could be 100% wrong, but be skeptical, because I also could be right. And if I'm right, things can get worse very bad, very quickly. So all I'm saying is temper your expectations, right? As investors, we all need to temper our expectations. So what can be possible, but also what can go down. I still remember when people on the Palantir community were like, Palantir will never go down below 15. That's not possible. It's never going to happen. Well, guess what? it touched 6 something in May, right?
Yeah,
So-
and I think and that's why it's good to have these conversations. So for everyone in the chat
Right.
that's kind of against
Yeah,
Chris's
you
bear
need to
argument,
have
that's the point of a
both
podcast, right? To
sides
have
of the
perspective.
story. And
Right.
look, Chris brings up some really good points. I think we should start earlier and do another podcast. But the one thing
Yes.
that I want to add is, for me, SoFi has been through trial by fire right now. They've been operating with their largest business segment that was cut in half and operating under half mast for part of the past 2 years. And this is a company that faced a ton of adversity and when put to the test, had to, and I repeat, absolutely had to diversify their revenue streams and built out all these other lines of revenue to where student loan moratorium doesn't even impact them now. So that's why I'm looking past 2023, because they're going to keep building. And when that line of business actually does come back, if they're not out of business, which I don't think they're going to be, I think we can see something very special down the road in the back half of the 2020s. But that's
All right, we gotta go.
I think the next
Everyone, we
quarterly
gotta go.
report will
Everyone,
be
we gotta go.
interesting.
We gotta go.
Everybody who wants to know about accounting, go read my article and about
Yeah.
loans on the balance
Chris,
sheet.
Chris,
It's
can you
Another
put
deep.
it-
seller like
Chris, can you
me.
put it in the chat real quick. Put the link in the chat.
Go
Sure,
subscribe.
I'll copy it.
Everyone, please check out this article. It's 4,000 words. Put a lot of effort into it.
It's really
Um,
good.
Let's get him
It
some
was very
Seeking
good.
Alpha revenue as well. He
There
definitely
you go.
deserves it. 195 people. This was the biggest turnout.
Now,
Thank you guys for
I
being
gotta
here.
go bearish against Palantir, man. I'm having a
Oh, let's go.
Steven, I sent you the link in the Twitter, so we're about to hop on Palantir Weekly.
On the
For all
Twitter.
190 people who care about Palantir, we'll be starting in like
Stick
2
around.
minutes.
Hey,
Chris, did you put it
hey
in the
guys.
chat?
See ya.
Here, not in the private chat. I'll put it
Okay,
in.
here's what I'll do, guys. I will pin this as the top comment. So in like 20 minutes, that his article link will be the top comment under this video. But also you can just type in SoFi on Seeking Alpha, right, and it'll pop up.
Yeah, it'll pop up.
Okay.
It's
great.
like the third.
Thank you, everybody.
Okay.
We'll see you next week.
And Mick,
Thanks,
you
everyone. This was
email
super
me-
fun.
Progress.
Thanks,